This is a video help file to help you complete Chapter 2 Spreadsheet exercise. Now in this chapter we talk about taxes, corporate taxes. So in the first frame, tax rates, I have two problems. So the first problem, I have the tax rates here, the tax brackets for companies. So companies that make the first $50,000 all companies make, they pay 15% tax on. And then the next $25,000, the money between $50,000 and $75,000, they pay a 25% tax. And if they make over $75,000, every dollar they make over $75,000 up to $100,000, they pay 34%. And then again, any dollar they make above $100,000 to $335,000, they pay 39%. So here I have a company that made $150,000 in earnings. So I need to break up this $150,000 into the different tax brackets. So the first tax bracket is a $50,000, $0 to $50,000 tax bracket. So I'm going to come in here and I'm going to say, I'm going to take the 50,000 and multiply it by the 15% rate. So that's how much this company would be responsible for paying for the first tax bracket. In the second tax bracket, I can fill up the second tax bracket and I can multiply the 25,000. So far I've only accounted for $75,000 worth of money. So the next 25,000 will be calculated at that same rate. And then the last 50,000, so if you add up these four values here, 50, 20, 75, 50,000, 75,000, 100,000, 150,000, we're going to get to calculate the amount of tax on each of the brackets. So the total tax is going to be 41,000. Now the marginal rate is going to be whatever the last tax bracket rate is. So this marginal rate is whatever the last rate bracket that we touched. And the average tax rate is going to be the taxes divided by the total earnings. So this would be the average tax rate. Okay, so marginal is your highest tax bracket, and average is just the percentage of tax to income. Okay, so the trick here with this is, the larger dollar amount you have, it's any problem too, you have to break it up into more buckets. And I've already done the parceling out of the money, and you'll see that for this last tax bracket, even though you can fit $9 million in there, we only need $165,000 of that to complete. Okay, so that's how you would work on the first sheet, tax rates. The second sheet is tax deductions. So in this sheet, we have problem one. So I'm going to walk you through problem one. Okay, so we have two different scenarios. We have the scenario with debt and without debt. So we have earnings, the EBIT stands for earnings before interest and tax, less the interest expense of $30,000. So earnings before tax would be $200,000 minus the $30,000. So my tax on this is going to be 40% of $170,000. So my earnings after tax are going to be my earnings before tax minus my taxes. All right. Now, in a situation where I have no debt, my earnings before tax will be higher. So my taxes times that same 40%, I'm going to pay more in taxes. So my earnings after tax is going to be less. So the difference, the change in after-tax earnings would be $18,000. So what happened here is one company has debt, one company doesn't. So the debt actually is tax deductible. So you can reduce your earnings by the amount of interest you pay on your debt, and that gives you your earnings before tax. So here your earnings before tax are $170,000 because you were able to deduct $30,000 in interest expense, while here they have no debt, so they have no interest expense, so their taxable liability is higher and they pay more taxes. So the end result is, if you have debt and it generates interest expense, you could wind up having a lower tax liability. So your taxes here are $68,000 versus $80,000. But bear in mind that you still have a lower earnings after tax because you did pay $30,000 in interest expense. So you do come away with more money if you don't have any debt or aren't paying any interest. You just have a higher tax liability. So that's sort of the purpose of this example. And now the last example on this spreadsheet is a rather involved one. And this comes from the spreadsheet example at the back of the textbook. So in here, I'm going to ask you to look over this company and conduct a tax analysis for Hemingway Corporation. And I want you, let's go over here. Let me make this a little bit bigger. I know I got to remember always to do that because it's sometimes hard to see on the video. Okay. So what is the current current annual corporate liability tax? B, what is the current average tax rate? C, if Hemingway finances its expansion using cash reserves, what's the new corporate tax liability and average tax rate? D, if Hemingway finances its expansion using debt, what is its new corporate tax liability and the average tax rate? And E, what would you recommend? Okay, so this problem is a little bit more involved problem, but it's combining what you learned in calculating tax rates, calculating tax deduction into one problem. So here are the marginal tax rates for this problem, and I want you to calculate the tax liability. So the income is $200,000. What would be their tax liability based on this schedule? Similar to what we did over here, but now more in a word problem. Then B, calculate the average tax rate. We did that over here, calculate an average tax rate. So I want you to calculate that here. C, using the cash reserves, the new tax liability and average tax rate is found below using the corporate schedule. So in this example, we're basically saying if we use the cash reserves, what would be the new tax liability and average tax rate? So again, you'd have to calculate the tax liability on $350,000 and then the average rate. Now part 4 would be part D with debt. So if we had debt generating interest expense, we have a new taxable income. So we want to figure out that if we use debt rather than cash reserves, what is going to be the difference? Okay. So let's just go back up here for a second. So this is the current tax liability. This is if we use cash to buy, up here they're talking about an expansion. So if you read the top part of the problem, they want to expand their operations to boost income. And they want you to do a consequence analysis saying that, before it used to generate income of $200,000. After the expansion, it'll generate income of $350,000. So they can either pay for this expansion with cash or borrow debt. So they want to know, this problem is basically asking, if we borrow debt, the interest expense is going to be $70,000. What's the tax differences? So the first part, we're calculating the current tax liability if they don't expand. Then we're calculating the tax liability if they expand and pay cash and have no interest expense. Then in the fourth part, we're going to figure out if we do take a loan and have this interest expense, what is going to be the new tax liability. And we'll see here already, I calculated for you the tax liability is lower because we have interest expense to deduct. So in all three of these cases, you're taking in $200,000 and you're breaking it up by these tax rates to give me a tax liability. And then in C, you're taking the $350,000, the income on expansion, putting it into these tax rates and coming up with a new tax liability and average tax rate. And you're doing this for a third time on the $280,000. So just like we did over here, we're going to break up the taxes by these tax buckets, and you're going to tell me what the tax liability is, which is going to be a total amount, total tax or tax liability, and the average tax rate for these problems. Okay. After you complete those three, so you're going to use the tax schedule to complete 3 separate tax scenarios, and then you're going to recommend to me what should be done. So you're going to give me the current income tax, the expansion with cash reserves, and expansion with debt. So basically here, You're just pulling in your answers from the previous questions. Tax liability from C, and this would be tax liability from D. So you're just pulling in summarizing your previous answers here, and then writing a little information about which you consider is the best recommendation. Okay. So, and again, this spreadsheet exercise is directly from the book. It's the end of chapter spreadsheet exercise, and I want you to do your best with this. So I've given you the basic concepts and skills in these first two spreadsheets, and then the third one, I want you to apply that to this more comprehensive problem and do your best you can with it. Okay, so that's been the help file for Chapter 2 spreadsheet exercise. I hope you found this helpful. Thank you.